Options trades are exceeding stocks for the first time since 2021. And with $5 trillion in expiration coming, Goldman Sachs has a warning for all of us as traders and investors. Hello, ladies and gentlemen, and welcome back to The Daily Show, where we discuss stocks, commodities, and cryptos together. My name's Tom, and upcoming in today's show, we have some of the biggest sentiment reports, key charts, macro data, and the question that we've all been asking ourselves recently: are we heading into the dreaded stagflation? With hot PPI numbers and weakness in retail sales, there's a lot to discuss, and some of the charts that we expected to break out have certainly happened this week. So let's discuss all the markets around the world, including the hottest and the weakest right now. Well, welcome back everybody to The Daily Show. Remember to subscribe, smash that bell icon, and of course comment down below if you love markets like we do. Of course, we're going to be discussing everything about them today, as there's so much to go through and some amazing charts coming out over the last 24 hours. But more importantly, we saw some weakness in some more sectors. Tesla got belted all the way back down to those support lines that we'll talk about later on, and NVIDIA and semiconductors started to weaken across the board. So what gives? Well, it was actually the energy trade that was most interesting for the session, and PPI forced us there. But first up, I want to start with what is the worst performing stock of the S&P 500 this year. Now, if you didn't look at this chart and you answered Tesla straight away, then you're one smart cookie, because I would have thought it might have been Boeing. However, Tesla has outpinged Boeing now at 34.6%. And I posted this over on our X account with some other interesting stocks as well that have not been doing so well in what has been a pretty big bull run so far. So what gives in this market right now? Well, let's talk about economic updates this week. We've got hot CPI numbers coming in very strong. We've got weaker than expected retail sales, not so good in terms of growth. And then we have hot PPI numbers, the highest since 2022. So what's coming back? Well, it looks like we've started to see inflation. And the problem is oil, copper, gold, and of course the energy sector, which we've been talking heavily about over the last 2 weeks on this channel, have all breached through. So is it the beginning of a stagflation play? Well, let's take a look at the rotation that went through all of the markets over the last couple of sessions. First up, what was the best performer of the last 24 hours? Well, it was actually the energy positions. And we also saw some defensives come back into the party, including healthcare and a few others. If we take a look at the last 5 days, of course, we've been talking a lot about gold, but we've also got metals, we've got energy, and we've seen gold break through. Also, interestingly enough here, we've got the rise of financials coming back in to one of the best. And this is the last 5 days, so it's not like it's just been happening in one session. It's now been prolonged through some period. So let's talk about what's doing good things and what's maybe not doing so well right now. Now, I don't even know if we should call it the Mag 7 anymore, because of course Tesla really needs to be taken out of the Mag 7. But it's not just Tesla, it's also Apple, which we've been looking at recently. And then of course, we've also had big moves in Meta, NVIDIA, and Microsoft. Now, if you know anything about this channel, you'd know I love Microsoft very much. And in general, it's one of my favorite stocks. NVIDIA also there. But are we starting to see peaks in Meta, NVIDIA, and Microsoft? Well, we'll look at the charts later on, but certainly Microsoft doesn't seem to be wanting to give any peaks away just yet, with breaks up through that current accumulation, or what looks like accumulation zone. Let's talk seasonality for a moment, because of course it's not working so far this year. And what I mean by that is, generally speaking, if you're going to see some weakness, it tends to happen in this February to March period. Now, this is an overlay of what's currently happened with the price action. And as we've been talking about, we're currently making a series of higher highs and higher lows on the charts, which we'll look at very soon, holding above the all-important daily 20 moving average, which is often considered very important. But I thought this chart was amazing here. And what this is it's taking back over the last 100 days and really correlating here all of the previous markets that have looked like this. And I do love these types of charts, because what they're showing us is they're showing us a lot to do with what generally does occur in these similar situations when we've had rallies like this. And this is one of the best overlays we've seen so far. So when you think about it, what's going on here? Well, there's sometimes a little bit of confusion that tends to happen here. Now, these are the most correlated markets. So we've got 1960, 63, 1995, 16, 1970, 2017, and 2010. So some pretty interesting references there, and it suggests that the next kind of, like, let's say 50 trading days or so might be a bit all up and down and around. but then the trend in general should remain in the bullish intact zone. If we actually take a look at 2012 versus 2024, which is one of the more correlated ones as well currently, you can see here over the last couple of weeks, when we look at this type of correlation, again, it starts to look a little bit shady when we're moving forward through the next couple of sessions. So will it be a post-OPEC sell? Well, a lot of this comes down to gamma positioning, and we will look at that later on today's show. But let's break down what happened over the last 24 hours for the S&P 500. And one of the things that we've been seeing here is a little bit of weakness, but really not that much yet. So who won the last 24 hours? Well, if we're answering it, we're going to always say, of course, the bears won. They ended up creating a red candle. Do we remain still above, though, the 20 moving average? That's that red line here that we've been posting for quite some time. We certainly do, and you can see here we're still making a series of higher highs and higher lows. However, we still haven't popped through that 5,200 level, which we know is a huge gamma positive switch, which probably means a lot of hedging has to be done in the markets, and we'll look at that soon. What I want to break down, though, is the smaller time frame. So let's take a look at a 5-minute chart together, because you'll notice there was a wick at the end of the day, which means that someone bought into the close. Now, generally speaking, if you know anything about markets and you've been following them for a while, you would know that buying into the close often is the bigger players. So they've been trying to hold it up, but we started somewhere around here for the session, then we broke down, then we made a series of lower lows and lower highs throughout the session, and you can kind of see this 5160 is a key point for the bulls to take control of. So that will be something that I think day traders will be looking at over the next 24 hours. More importantly than that, though, we have options expiration. And this means that we have the possibility of getting rid of a ton of options, a ton of gamma, and resetting things for next week. So what I put on this chart for us all is the key resistance levels we need to be watching over the next 24 hours. Obviously, 5,200, a big resistance zone. And from the bear side, we also need to be looking at that 50.93, which correlates very well with the 20 moving average. And if we move under here, we're basically going into the first time negative gamma environment. Now, we'll update this throughout our weekend video, so make sure to subscribe for this. But we'll also be talking about where swing traders potentially take control of the market, which is probably going to be around 50-50. So some key points here in terms of turns that may be happening on markets moving forward. But for now, remember, it's still a series of higher highs and higher lows, which means the dips are being purchased even with the economic data looking the way it is. So that's something that's very important to note in these markets. Now, are we overextended? Well, in many ways, yes. But of course, when everybody expects pullbacks, as we've already seen, oftentimes they won't occur. We're in the greed functionality here between 73 and almost back into the extreme greed after the last 24 hours of readings. Just a quick reminder, if you're interested in following us in the other social medias that we have, check it out. Links in the description down below, including our newsletter that we pop out all the time. So let's talk about Goldman Sachs warning now. So of course, they've been going on about the idea that the VIX might spike up. And according to their models anyway, they're seeing a current VIX of around 13.8 when it came out. Obviously, it's a bit higher now. And they think that the VIX model value for April should be around 21.5. Wow, that's a big difference. And of course, their long-term VIX average is 20, which makes sense. I mean, we know that the VIX has been suppressed for some time. And one of the things we've been talking about recently is the idea of, again, a huge option switch where 16 has been one of the most important levels to be looking at. Until we really breach through 16, I think it's unlikely markets will go super bearish or anything like that. And the main reason is because that has been suppressing the overall VIX volatility for quite some time. So Goldman Sachs believe that April is a month that has macro, micro, and all sorts of different environment features. It also has a big average in terms of VIX. Will you be somebody that actually is trading the VIX? I did say this over on our X account. Just remember, the VIX is incredibly expensive to trade, so you got to be very, very careful. What is generally better to do is you're looking for signs of volatility, looking for things like gamma switches, looking for lower lows to actually happen on the market, and then maybe towards the next point. And we'll talk about those as we go through, of course, the S&P 500 moving forward and Qs, etc. So what's going on with S&P 500 and rate cuts? Everyone's expecting a rate cut, but with hot PPI, hot CPI, it's going to be hard for the Fed to do it. And I think this is one of the important factors. We already know that generally speaking, into a rate cutting cycle, markets will perform well. Then it comes to the rate cut. And I've said this before, the speed of the rate cuts is going to be very important. If the rate cuts are really fast, it means they broke something. We've got to be a bit concerned about that. If the rate cuts are orderly, that is once every quarter or whatever they're going to do it as, then generally you will have a more bullish environment. This is a great chart to save and make sure that you have it from Ned Davis Research, and I think it's one of the best that I've seen all year. Let's talk about the last 24 hours. What's happened? Some members in the community have been very good to us because, of course, they've been tracking the Fed funds rate futures. And you can see here the changes between what's been going on. And basically, we are almost back to those points that we saw last year during October, which is here in terms of where the rates are sitting. So less rate cuts. And now we're actually finding a trajectory up to 2025, which had the market freaked out last time. Of course, it's not doing so this time. And there's some reasons behind that being earnings season and growth. So let's talk earnings. Yeah, were they pretty good? Absolutely. But what about the forward projections of earnings? Well, of course, it doesn't look, when we've brought this chart up before, it doesn't look like we basically have very good odds for the Magnificent Seven. But where we do have pretty good odds is in the other S&P 500 stocks. The other 493 is set to outpace the Magnificent Seven. And the good news for everybody that believes this year won't be a recession is in non-recessionary years, generally speaking, the economists in terms of their overall average are usually correct about the forward projections. So we tend to hit more of those kind of 5 out of 10 and plus readings. Now, if you know about what I like to see during earnings, generally everyone comes in optimistic into markets unless it's a very pessimistic time. Then what you want to see is you want to see about 7 out of 10 expectations. So slight beats always gets the market very excited. Then they start forward projecting even more. And you can see here the forward projection levels and what's expected in terms of moving forward. So 2024 still could be good for the bulls. And of course, I think the expectations are that the mid caps and the small caps are going to be where better performance is over the medium term. So what about the sentiment reports? Well, this week shows that the confusion is real in markets. Did we see bears increase? Not really. Did we see bulls decrease? Yes. And what this is showing us that into this week's OPEX, there's probably a bit of profit taking that's going on even from retail traders, and it's being shown throughout many sections of the market. Goldman Sachs, of course, has come out, and this is a great chart update from yesterday's one, where it basically shows us that US equity sentiment indicators are getting back into those readings that we saw before the sell-off of July 23. Now, based on the convexity and on the movements of the last 100 days on markets, you can see that this is a period that we go into whipsawing action, but we haven't seen it yet on the price action. So, of course, price action will be important. These are all just reads that help us understand the market a little bit better. And that means that if that does happen, we can kind of see what's going on. Here's a wild chart. I had to include it. It's semiconductor daily flows. And I think it'll come as no surprise to most of us that semiconductor daily flows are absolutely going ballistic. Everybody's cottoned on to semis this year. It always has been my favorite overall ETF, of course, in general for the US market. If you look over the last 14, 16 years, it's pretty sure that semiconductors are going to do well. We talk about a lot in our Monday live open show, so make sure to sub for that as well if you're interested, which we do completely free here on YouTube for the open. And because of daylight savings time and the fact that I'm in Australia, it's a good time to be coming to the show because it's getting closer to the actual open rather than about 2 to 3 hours before. So let's take a look at consensus forward PEs. If we do get a dip, what generally is going to sell off? Well, we might see Mag 7 stocks sell off. And in general, if we then get a rip, they're probably going to be the ones that come first. But if we do get a rip after that point, could we be looking at mid caps and small caps? They still remain historically low compared to where they were back in 21 and even back in 2019. And it really is where you get that opening in terms of better opportunities. You can also see rotation starting to occur in these markets, which I think is a super key point. We also need to realize that markets can go a little bit more extreme than you think. Now, if we do end up going into, some people call it a hyper bubble or a late stage cycle bubble. Remember, when people are saying bubble, which has become the word recently, generally markets actually won't get destroyed. They might correct, but they won't get destroyed. So it could be that we're going into late cycle. And I tend to believe the debt cycling anyway, which is what we're doing right now. And we've talked about this again in our Monday show and daily shows, that I think the debt is completely ridiculous. And I think that what's going to happen is that the markets will go into a hyper bubble over the next coming years. And we may see 25x plus in terms of the S&P. Now, that's going to push us a bit higher because, as we know, we're only sitting at 20x. So at this stage, it is really a buy the dip kind of scenario, and we're still seeing that in stocks. So I thought we'd come over to the big volumes of the last 24 hours, and a lot of you have been mentioning in the comments down below MSTR, MSTR, MSTR. Huge breakouts in this recently, and of course there were some big trades during the breakouts, which you can see here marked by number 7 and number 10. But something weird's happening up here. I don't know whether it's accumulation, but there were dark pool activity on dark pool activity on dark pool activity, which probably means someone's trying to sell these highs and do a little bit of TP. Remember, it's a huge extension in terms of the charts, and we've seen some big levels there. So that's one to watch. The other one has been SMCI. So it's something we've spoken about. Again, some big trades up the top. I'd say it's some kind of take profit targeting, and we've already reported on this one before. So far it's gone down a bit. NVIDIA's also gone down a bit, and we'll look at semiconductors versus the market later on. Now, I know you can't read this chart, but basically what it's telling us is we're going to lose about 46% of the GEX. And what that means in options is basically that we're going to be opened up to a complete restructure next week. This OPEX is more than just the expiration itself. It also changes everything about the levels that we're seeing in terms of options. And if you've been wondering, yes, this year's really been run by options. A positive gamma environment plus higher highs and higher lows has really been leading into this market going bullish. But that could be set to change if we get changes in the options market. And of course, we'll be first to report it to you if that does happen. In this case, you can see here the 5200 strike. You can also see that 5150, which is holding the last 24 hours. That's why it's been sitting there. So it could be actually a bit of a fizzer here on OPEX day. Maybe it's going to be volatile, but there's like being pinned between 5150 and 5200 at the moment. You can see in the options world. If it breaks through 5150, we're more than likely going down to that 5100 zone. And of course, if we got through 5100, that's a pretty big deal because that's our HVL level. And what that's telling us is that we've got a lower low. And on top of that, we're also starting to get more into that negative gamma environment. So for now, it's positive gamma. 5150 is pinning the market. 5200, obviously above that, would be a huge zone for massive breach outs. But at this stage, that would probably be the levels that we would cap ourselves in. So 5200, 5150, and under 5150 would go to around 5100 for the SPY. Let's now take a look at the future in terms of what's been happening. And you can see here that there's some weird stuff going on next week. Now, one of the things that I think is most interesting is that when you look at the 18th, which we know is an NVIDIA day, so this is NVIDIA day coming up, guys, then we know, and we'll do a special on that in the weekend, then basically we know NVIDIA is really running a lot of the sentiment right now. It is the stock that is skewed, and I'll put this chart in the next one, it's skewed to the point where it's all calls and no puts. So if NVIDIA can't live up to the monstrous expectations, which it has done every time so far, if it can't during that 18th day, again, things could get wild, things could get volatile. So it's not just the options expiration, but it's also going to be that point. We'll update you on these charts as they come in. Some other things that were weird about the market looking a little bit weak is, of course, when you take a look at some of these indicators, and basically we're looking at percentage of stocks above certain moving averages. We're looking at advanced decline ratios here, and you can see that there's little tick downs as the market's holding up, which is showing you some of the internals are looking weak. But we have had that before, and what it's done is just gone sideways and then driven up anyway. So again, not a high enough read yet, but something we will look at and we'll come back to. Now, we have been mentioning CTAs, commodity trade advisors, and basically they can sometimes front run pullbacks in markets. Now, if you take a look here, you can see all the previous times where this has happened. And of course, we've seen the weakness in this particularly through, of course, the NASDAQ. We'll have an update for our weekend video, but you can see here that we're starting to make a series of kind of lower lows and lower highs when it comes to the CTAs overall. And they're starting to maybe drop a few positions. Now, it's probably a bit of profit taking. We're not quite at the peaks that we saw back in June and July. Remember, Goldman Sachs indicator was showing a lot of extension at that point. But some interesting charts, none the same, to be looking at. Again, price action will be key. For Friday, we have prelim UOM coming out, and we also have here, of course, a warning coming through, which is the stock market could see extra volatility with the triple witching feature, which means the simultaneous expiration of stocks options, stock index futures, and stock index option contracts. And yes, that will be the volatile period, but at the moment, it looks like we're pinned. Do remember that options is moving the market right now. And of course, why do we know this? Well, look at this. Look at some of the expiration coming off. 47.4 million. That's a huge number in terms of options. 41.8 in terms of average. This is almost now at 42. We were at 38 last year and 56% calls. So it remains incredibly call overbought here and everyone's buying calls. Again, the skew is completely wild right now. And many houses, I've been reading reports from everywhere around the world, Goldman Sachs, UBS, Nomura, obviously everyone else, Bank of America. And what's coming out is everyone's like really confused about the skew because, of course, it's one of the worst skews we've seen on record. Now, that could mean something weird's coming, but we don't want to predict that. So at this point, what we're doing is we're looking at the price action. Obviously, we're looking at the opportunities that are rising in many different markets. And that's really been, I think, the key here. In terms of overall relative 90-day volumes, almost all of them were actually higher. And you can see here some of the big breakouts. S&P 500, though, very interesting here. Call volume outpacing put volume. Again, kind of rare, unusual to see. Let's talk VIX now and get into the chart. So straight away, VIX 16, set the alert. That's all we really need to talk about with VIX. We're looking for it above there. Another overall market that a lot of people haven't looked at for a while has been the move as well. Now, the move here is the bond market option volatility, and you can see that's dropping back down into these lows. Now, we'll do some analysis on this on our weekend video, but I just thought it was interesting. Put it on your charts, start to look at it. It's always a good one to have at hand. Let's now jump on over to bonds. What are bonds telling us? Well, we know that high yield junk, which often is considered kind of that precursor sometimes for markets, remains coiled. So there's no negativity necessarily here, although it did drop off, but of course it's going to drop off. We saw yields go up across the board, which is of course a weakness for bonds. In terms of my overall bond indicator, it's not looking that weak yet, which is surprising, but hey, that's the data. That's what it's telling us. We're still in a coil. We haven't broken to the upside, nor have we broken to the downside, showing that we should really still be with the price action. What about the American consumer? XLY versus XLP, a great indicator of whether we're seeing growth strength or whether we're seeing defensive weakness. Still holding, no new low. Obviously, we'll update on that one. Copper breakout has been significant. It could mean that we're in stagflationary times. And basically what this is telling you is that we need to start looking at metals markets in particular and breakouts through that. In particular, oil as well, which we've been covering heavily on the channel. And I know a lot of you are like, oil is boring, man, whatever, dude. Man, there's times when it's worthwhile checking out. And we've been polling you guys as well. So if you have comments on how you'd like to see the show improved, we're going to do a little bit of flipping up here. Still keep the core, but I'd love to make sure that you are getting exactly what you guys want to see. So hopefully you're enjoying today's content. Let us know down below. I've added some extra stuff in here. Let's have a look at the USD. So the dollar index did spike up and it did make a new low the other session. Obviously, we've been tracking this and we've been liking the euro against the dollar index, and it hit one of our major TPs. It rejected back down, and it is a pretty critical point. The dollar index is obviously going to move up on the expectations of higher rates for longer. But if we have a look at the euro here, it's back to the 20 moving average, back to a trend line sitting behind, and a level where I think day traders will start to come in. You can see here I've got this little demand sitting behind as well, which is a key zone that we want to see how this ends up reacting. So it's pretty fast. It's like kind of trying to buy into a falling knife. So we've got to be very careful, but we will be updating that over the next 24 hours of options expiration. Gold remains bullish for now. Weekly close seems to be set for a little bit of negativity, but overall still holding up. Basically, it's buy the rips at this point, or buy the dips and sell the rips at this point if you're a trader. And Bitcoin started to take a little bit of a hit. So this has gone down from 73. It's still finding buyers for now. You can see when you're looking at these charts, remember wicks do hold the keys. They're very important. And you can see here wick rejection followed by a secondary wick rejection. So really what that's telling us is that we have some strength in the buy the dips at this stage. But if this level's taken, which is something we've already had highlighted, the 68,871, then that's starting to show that the bears are getting a little bit more control of this market. And maybe the first sign of any weakness since that 15% sell-off. So remember with Bitcoin, especially into the weekend, liquidity dries up and you can get those wild moves in this particular pair. Let's move over to the good news stories in the market, and that's, of course, energy sector. We've been following the energy sector for some time here. We saw the breakout in the start of March period, and it's been pretty good. You can see kind of Wyckoff style bases, and the energy sector is going for that really high period. It might be looking for a 92 plus breakout. Now, a lot of this is thanks to oil price. So let's have a look at energies here versus the SPY. And again, if you're someone that wants to go into markets where you feel a bit safer because they're maybe cheaper or something like that, energy sector versus the SPY, again, you can see breach outs here from what has been a pretty negative trend overall. Now, if we go over to oil, it's thanks to oil breaching that 80 level. It took long enough, yeah. Coiled for ages that it finally breached out. We loved these two candles here. Obviously, I was a big fan of what I was starting to see, and it moved up to 81.14. I still think there's room to give. 82.50, 84.50. UK oil, from a price action based perspective, you can see here, breached at 84. It actually went early, which we reported on. And this one here could be set anywhere upwards of around 86 to 87 a barrel. So still some more room for UK oil and oil in general. And what it could be is the beginning of the market saying, you know what, stagflation might be here. Oil, gold, as we mentioned, all of these types of things tend to run in stagflation, and even property as well. So property can hold because, of course, inflation puts perspective on buildings and the overall cost of building. Let's now move over to the single stocks before we go through some more indices and some more opportunities there. We'll start with Tesla. Well, Tesla got belted. It went back to our possible return point, posted this over on X, and this is a level where you can kind of see that it's getting pretty heavily sold into this zone. Now, is it an extreme level yet? Not really. So even though it's fallen off, it hasn't really shown those signs of full complacency, full destroying of the stock. Some levels that will be worthy of setting alerts for, the new low here, which would be just underneath 150, 151 zone. Then also the gap fill that sits here at 145. Now, if you've been following the channel for a while, you'll know that during this point, I kind of called the sell of Tesla, and I was ranting on about 145 and the 61.8 fib there, and then we ended up reversing. And the key to any trade is often, or trading in general, is often when you are wrong on something, when it does break to the opposite side, you've obviously got to remove that position. And that's what ended up happening in that point. I just thought it was interesting because it's a very long time ago, but it is actually still the gap fill that sits on these charts. So I thought I'd break it down like that. Remember, the market closed close to its lows, so it's kind of signaling that it doesn't really want to buy up yet. The wick hasn't been purchasing. Those things haven't been coming through. NVIDIA has been one that we liked the dip on the other day. Then obviously I go to the sideways action for a while. You know, I'm very concerned about why it sold 13% the other day. I know we have our reasons, but let's be real. The whole semiconductor market sold off. So that's a bit of a problem. And you can see here it's kind of overall. So yeah, it's all down to the 18th. I think that is going to be the big one. And if NVIDIA can't live up to expectations, down it goes. Do you want to dismiss it as a stock you're holding for long term? I don't think so. I think NVIDIA's got, you know, the real potential to become possibly the biggest stock in the world based on how many chips we're going to need to perform all of this new AI stuff. But at the same time, it is starting to look a little bit weaker on the charts, which obviously is leading into a news catalyst event. For our stock of the week, we obviously chose PayPal, and it actually held up through that market section, which was 0.88%. A nice breach out here for PayPal. Loved the downward trend. Obviously loved the breach. It breached a while ago, and then it started creating wicks around my fib and my golden pocket. So I do like these kind of levels, and I thought it was a key one for us to be watching. Let's now move over to a combo, semiconductors versus SPY. So this is an area where you're starting to say, ooh, you know, what's going on here with semiconductors and SPY? And the reason I want to bring it up is because I love semis. Yeah, absolutely love semis. But you can see here that there are periods where semis versus the SPY go into cooling off zones. And we've had plenty of cooling off zones in the past, and where semis start to slow down a little bit, and they have had an epic run. So if we think about like the last epic run, so we go on here and we take this epic run, and then we extrapolate that epic run out, which is kind of like a flag into a flag. So that's actually hit that target. And you'll notice that it's pretty clean. You can just see it's kind of the way it's moved. So are we going into a sideways? Well, of course, we're hitting some big numbers. We are hitting extreme levels that are showing us that semiconductors versus SPY is kind of needing a bit of a cool off. We've got that big rejection wick. We've obviously got, you know, a bit of a sell here. I'm not going to go against semis. It's just showing that there could be some cooling here, and it might be time for the rest of the market, if we're going to keep rallying up, go through 5,200, which obviously would give us those rally points, to get into the mid caps and the smaller caps. And we'll talk more about those as opportunities moving forward. HSI, 17K, too much for it for now. So this is obviously the Chinese market. Been some incredible moves on it, some nice moves up. The whole world kind of did sell off, obviously, over the last 24 hours a little bit. And you can see here that resistance forcing it back down to the 20 moving average. We'll see how it ends up playing out. Like to see it kind of sit here for a few days, then gap up. That would be really awesome because that, of course, would give us a gap down, sit, gap up. Oh, yeah, that'd be nice. And then we can move towards 18,000. So definitely opportunity still in the Chinese markets. Aussie market fell through big time. Not liking everything that we're seeing right now. And it kind of almost is completing the head and shoulders pattern here straight away, which is going to push us back down to possibly a 7,500. So watch the OPEX. Ultimately, the Aussie market's going to trade off the American market, and that's going to be most important. Let's now move over to the American market. So as we've kind of been talking about, the US 2K, I wasn't convinced by its breach last week. 2090, big zone, 2120, set an alert. Above that, oh yeah, I'm looking for some big rallies at that point, momentum-based market. But we're getting back down to 2K, and I think 2K should be reached by the US 2K. And basically 2K for 2K. This is our overall ascending channel here, and we know that it's kind of going towards the bottom end side for it. So US 2K is certainly finding weakness here. Another one that we've been bringing up is obviously Q versus SPY, which is this combo code. A new low formed on that, even with... And remember, this is even with NVIDIA going down, but we also saw Apple, Amazon, Google, Microsoft coming up. It was just Meta and NVIDIA of those major Mag 6 stocks that was actually down from the session. So you can see here the rest of the NASDAQ was suffering. And one of the reasons why that's happening is because when we look at things like yield, we know that most of those Mag 6 stocks actually have good cash on hand. So they're not suffering due to the inflation. The small caps are, the biotechs, those types of things are really starting to struggle because they just don't make money. So they've got to refinance at higher rates for longer. So let's move over to the Qs. It was more of the same that we've been seeing throughout the S&P, but I thought we'd bring it up. So you can see here it touches that 20 moving average and it kind of weakens a little bit here by making a series of kind of lower highs, but no lower low yet. Nothing really changes in terms of our overall opinions on this particular pair. Actually, we'll go here and we'll use this one. And the reason why is because we do know that it's been making a series of lower highs, but more importantly, we also have the 17,788 zone, which is really where we make the new low. So yes, a lower series of lower highs is not a positive for the current market condition. Now, if we breach to the upside, obviously that means we were coiling, we were building accumulation, and we were moving up. So for now, is the trend still up? Yes. Does it have some signs of weirdness? Absolutely. Are semiconductors starting to show exhaustion? Yes, on the charts they are. Especially that semiconductor versus SPY, which I encourage people to have on their charts as a combo. We'll be doing a lot more comboing moving forward. So you can see here, this intersects with a whole bunch of things. Down the trend line behind the back, the new lower low, and all sorts of stuff. And I think OPEX, once it expires, and NVIDIA's 18th, those are going to be the days that will really push this around. Again, for the US 500, the key levels are the ones that I've popped on the chart here, and we are watching this very, very closely. And realistically, at the moment, the bulls are still in control, and we know that they did try to buy the end of that day. So again, if the markets want to push up, they go through the 5160, there's at least some options ability for the markets to try to push the 5200 narrative. And even against what you might think is a fearful time due to inflation, all these numbers, we know that the bull animal spirits are still very strong in this market. So they can push it even if you're left scratching your head saying, what the hell is going on? Maximum pain set to probably not hit, which is obviously sitting down here. It doesn't have to. And remember, we don't ever trade for maximum pain. And what that is basically the options expiration, theoretical best valuation for the markets. What instead we do is we have it on our charts. We know where it is. And if we see the break to the downside, then we can use that as a potential targeting zone because it's kind of like equilibrium for the options market if you want to look at it that way. Thanks so much for watching. If you enjoyed today's video, then remember to subscribe. Check out our other socials down below. We're sharing a whole bunch of charts and we're just getting started in terms of some of these exciting new things that we bring to the channel. Thanks for your feedback, guys. Love you all. Bye for now.